In this chapter, we're going to look at some financial statements, talk about some initial calculations and some performance numbers, but we'll also end up talking about some of the most recent changes in the tax code, which is obviously very important for making corporate financial decisions. So let's first start looking at some statements. These come from Molson's, Molson Coors. The information was gathered from Zacks.com. That's www.zacks.com. But I don't think we need to get into a lot of detail. You know that the income statement talks about what has happened over the past year. It refers to a period of time. What I try to think of when we're analyzing a company, it's a little bit different than investing, right? If you're looking to look at performance, we want to understand management's control, right? How did they control the business? So these numbers represent the operations of the company. So, for instance, gross profit. Gross profit is sales minus the cost of goods sold. So the only expense here is cost of goods sold. So gross profit reflects the control that management has over its costs of production. In this case, you can see that the actual number seems to decline over time. That might be obviously of concern to us. We'll talk about ratios in some later chapters. The balance sheet, make this just a wee little bit bigger for us. If you look at the balance sheet, everybody understands it just reflects, it's a picture of the company at one point in time. Of course, assets, we have short-term assets, long-term assets. In general, again, it's a picture. Assets represent all the things that the company has purchased to run the company. And I think that's kind of important, right? Management makes choices of what to buy. This reflects how much. It doesn't reflect the quality. Doesn't mean we bought good assets. It just means we bought assets. The liability and equity section, a little bit bigger section put together here. But as you can see here, again, liabilities just reflects, this side of the balance sheet, the right side, if you will, represents where did the company get the money to buy all the stuff on the left-hand side. So you can see here, $16,000 was gathered from creditors to purchase these assets on the left-hand side. The remainder, shareholder equity, $13,435, was gathered from the owners of the company, from the other investors of the company. So the left-hand side of the balance sheet reflects the things we've purchased. The right side represents where did we go to get the money to buy those things. The cash flow statement of the corporation, I think, is a very important line item or statement, right? But it reflects, here's the cash flow from running the company. So Coors every year has produced positive cash flow from making beer. So it is at least from that perspective, they're doing something positive. But we also look down below here. Here's the net cash from investing. The company is going to buy and sell assets. They could have some investments like, maybe they have some stock in another company or things. But primarily, you see, these numbers are all negative. So it means what? The company is buying things. There's a cash outflow. Down below, net cash from financing. How did cash come into the company? And you notice here, negative numbers across the board represent money going out, not money coming in. So they actually were paying off some short-term debt. They paid off some long-term debt. They also paid dividends, right? So this just reflects where the money came from into the corporation. In this case, it was all going out. So the cash flows represent money coming in from operations, money being exchanged for assets and investments, and then it reflects the financing aspects of the company. So how this all works, obviously, is into this calculation of what we refer to as free cash flow, representing a value of a company. So how do we find this free cash flow? The importance is it is part of our fundamental formula for the value of the company. Free cash flow, that's the numerator. Now the denominator, the weighted average cost of capital here, comes from the costs of financing. So the decisions we make about where we get money also are part of this value question. So what is free cash flow? Free cash flow is the amount of funds available to distribute to all investors after we've done everything else we wanted to do. We've bought all the long-term and short-term assets that we wanted to do. We have paid all of our bills. We've bought all the inventory that we want. So we've run the company, right? So we have operations or cash flow from operations. Everything that I've wanted to do this year is covered, and this is the money that's left over. So this money is available for the investors, stockholders, and the debt holders. So a company's value, as we mentioned, is dependent on this free cash flow number. So what can we do with free cash flow? We can pay interest on debt. We can buy back debt. We can pay dividends. We can buy back stock. We could buy some non-operating assets like marketable securities, maybe investing in other companies, right? But those are the 5 primary uses of this free cash flow number. So how do we calculate this number? Step 1, we need the net operating profit after taxes. We're going to go through the calculation now through the next couple of pages. The next thing we need to know is what is our net operating working capital and then net operating capital. So short term is step 2. In step 3, we also incorporate our long-term assets. Step 4, we're going to look at the changes in that investment, right? So this step 4 incorporates the changes in short-term assets, the changes in our long-term assets, and of course, then they are incorporated into subtracted from whatever our net operating profit is to determine free cash flow. And I will say that there are several formulas, right? As you go through finance courses, and if you go from company to company, they may change the formula, right? There's no set formula for almost any technique. It's whatever your company wants to use. And as long as they're always using the same formula, what you need to understand is you need to know, what does free cash flow mean? It doesn't matter how you calculate it. It's what the company calls it or uses to calculate it. You need to be able to explain and manage that free cash flow number. So let's look first. How do you find net operating profit? It is EBIT, earnings before interest and taxes, multiplied by 1 minus the tax rate. Now we're going to assume the tax rate is 25%. So for year 21, $1,454 times 1 minus that tax rate is this $1,090. So from a performance measure, we want to look at the numbers. What has happened over time? We can see that the number has declined, and there were 2 years with very low numbers. In fact, the net operating profit after taxes was actually negative in 2020. Now, lots of companies suffered in 2020. We probably know the reason for that. But we are concerned. If you look, the numbers were pretty stable. Now they've gone down. We're starting to see maybe an uptick. So obviously, it would be very interesting to know what happened in 2022. As with most financial statements, I'm sure you know it takes time for them to be published. So currently on Zacks, they only show up to 2021. 2022 has not been published yet. So what about operating current assets? So what do we include in this? It includes cash, inventory, and receivables. Those things that are used in operations. It does not include short-term investments, marketable securities, because they're not part of operations. That is an investment idea, not an operations idea. And of course, you can see what the basic number is. Now, what can we tell from this? Well, we can tell that over the last 2 years, the number is up a little bit higher. But the numbers are in the ballpark. They're only about, I know this is probably in millions of dollars, but it is really about $400 or so difference across the board. What about liabilities? The same thing. What's included? Accounts payable and accruals. Everything else in the current liabilities section is going to be excluded. Why? Because it's not part of operations. Now, the one thing that is excluded is notes payable. Not all companies have notes payable, but if it's part of current liabilities, we do want to exclude that. And really for 2 reasons. Number one, it's not part of operations. But number 2, since it is interest bearing, it really should be reflected outside of the free cash flow number, because free cash flow represents money that can go to creditors, interest, and paying back the debt. The interest piece makes this part of the free cash flow number. Next, let's look at net operating working capital. You just subtract current assets from current liabilities. Now, what you see here for Coors, it's negative across the board. So they have lots of negative net operating capital. Is that a problem? Well, of course, it could be a problem if this continued much further. Coors has been having some issues. So as a manager, what I want to look at are the variables in the formula. What are they doing about operating current assets? Why are these numbers so much lower than current liabilities? We either have to reduce current liabilities, which again probably isn't a great idea since that's accounts payable. That's how we buy inventory. But we also want to manage our current assets. So maybe when we get to our financial analysis, we'll be able to find ways to manage or maybe fix our current assets. I don't know what the problem is right now. To calculate net operating capital, we add net operating capital. We add net operating working capital to fixed assets. So in this case, you can see that in general, the numbers are fairly stable. We're in the mid 3,000 number for most years. So our operating capital total has been fairly stable. The challenge we seem to be having is with our short-term items. So how do we calculate free cash flow? It is the net operating profit after taxes, no PAT, minus the net investment in operating capital, or the change. So what we can see here is we have a couple of positive numbers, a couple of negative numbers. So what does that mean? The numbers could be negative if we are investing. Also could be negative if we have down years, right? If we have negative income, there's a good chance we might have negative free cash flow. If we have a negative number in our cash flow from operations, that will happen. Now, we don't have a negative number in our net cash flow from operations, if you remember the previous slide, but we now could say, well, where did this go? Did we buy something? So we want to now look to understand these numbers. We need to look at that cash flow statement to see where the outflow of cash was. If the outflow of cash was from buying assets, we need to ask, do we need to buy assets? Is that something that we absolutely positively need to do? Are we expanding? Or we could say, hey, did we pay off a lot of debt? And what you would see from that cash flow statement earlier is that there was a fair amount of outflow from financing. So we're paying dividends, we're paying interest, we're buying back debt, and we're buying back stock. So that is where most of this cash outflow went. So what can we do with free cash flow once we know what the value is, right? We can make interest payments, we can issue or reduce debt, we can make payments of dividends, and of course we can either issue or we can repurchase equity, right? But primarily this is money that can go to our investors. Look forward to seeing you in the next video.